Most people, the second they turn 62, log straight into ssa.gov and file. They figure they've earned it. They want the deposit. End of story. But here's what almost nobody tells you. The 12 months before you click submit on that Social Security application. That quiet little window, that's when the most permanent decisions of your retirement actually get locked in. And once you click submit, your benefit number is essentially baked in for the next 25, 30 years. So what do the people who get this right do differently? They handle 8 specific things first. Before they pick a date. Before they call SSA. Before they sign anything. And these aren't tricks. There's no loophole, no hack. Just 8 quiet upgrades that decide the size of your check, the taxability of your check, and how the people closest to you are protected once the deposits start hitting. The boring stuff. But it's the boring stuff that determines how Social Security at 62 actually plays out for the rest of your life. So today I'm walking you through all 8 why each one matters, and why doing them in this exact window is the difference between a benefit structure that quietly works for you and one that quietly works against you. Let's start with the one nobody at SSA is ever going to call you about. Here's a question almost no one asks before filing. Does Social Security actually have your earnings record right? While you were working, you trusted that your employer was reporting wages correctly. Your W-2 said one thing. You assumed SSA had the same thing on file. End of story. But the moment you start thinking about filing at 62, that question flips completely. Because in my experience, more often than people would ever guess, the record is wrong. A year shows up as 0. A year shows up at half. A 1099 from a side business. In 1994 never made it into the system at all. And here's why that matters more than almost anything else on this list. Your benefit, your PIA, the primary insurance amount that drives every check you'll ever get, is calculated on your top 35 earning years. Think of it like a championship being judged on your 35 best games. If even one of those games is missing from the box score, your average drops. Forever. So one missing year, 1 0 where there shouldn't be a 0, doesn't just lower this year's check. It lowers every check every month for the next 25 or 30 years. So fix the record first. Go to ssa.gov, set up your My Social Security account, pull your full earnings statement and walk every single year. Compare it to your old W-2s, your old 1099s, your old tax returns if you still have them. Find a mismatch? Submit a correction with documentation. The people who do this before they file end up with a permanently higher monthly benefit than they would have ever gotten if they just trusted the system. Once that record is clean, you finally have a real number to build every other decision around. Now ask yourself something most people never sit down with. How long do you actually expect to live? Because that one answer changes everything about when you should file. Most people, when they look at the SSA statement, they see the monthly amount at 62, at 67, at 70. And they pick the one that feels right. But feeling right isn't a longevity model. The right filing age depends on how long you actually expect to live, what your spouse's longevity looks like, what your family history says, what your current health says, and how much of retirement you actually want to enjoy in your go-go years versus your slow-go years. Here's the math nobody runs. The break-even between filing at 62 and filing at 67 lands somewhere in the late 70s for most people. So if your parents both passed in their early 80s, and you've got a couple of health things going on, that break-even matters a lot. But if your mother is 92 and your father lived to 89, well, the math goes the other direction quickly. And the lifetime number isn't even the only number. There's a lifestyle weight too. $1 of benefit at 63 buys you a trip with grandkids who actually want to travel with you. $1 at 84 buys you a slightly better recliner. Same dollar, very different value. So before you pick an age, sit down and map your expected years on paper. Weight them by health, weight them by lifestyle, then compare claiming ages on cumulative weighted dollars. Not on the SSA brochure. When somebody asks me when they should file at 62, I always say the same thing. Run the model first. Because the right answer for your neighbor is almost certainly not the right answer for you. Now here's the trap that catches people who file at 62 while they're still earning. They have no idea SSA has a separate set of rules just for them. And those rules can quietly claw back chunks of every deposit before you even notice. A lot of people who file at 62 aren't fully done working. They've got a part-time gig, a consulting client, maybe they're still W-2 at 30 hours. And before you reach full retirement age, every dollar you earn over the annual limit. And that limit changes year to year, but it's in the low 23,000s right now. Every $2 over that, SSA withholds $1 of your benefit. In the year you actually hit FRA, the rules loosen. The limit jumps way up, and they only withhold $1 for every 3 you earn over. After FRA, the test goes away entirely. Now here's the part that throws most people off. That money isn't gone forever. SSA technically recalculates your benefit at FRA and gives some of it back through a higher monthly amount. But technically is doing heavy lifting in that sentence, because the cash flow disruption in the years before FRA is real. So if you're filing at 62 and you're still earning, say, $40,000 a year from a part-time job, you could see a chunk of your benefit clawed back month after month and not even realize it's happening, until you check the deposit and the number doesn't match. So model the earnings test before you file, not after. Take your honest earned income forecast. For the next 5 years, run it against the limit and decide on purpose. Maybe you delay filing by 18 months until the part-time wraps up. Maybe you scale back hours. Maybe you proceed with eyes open. But whatever you choose it on purpose, not by accident. Now if you're married, everything I've said so far gets more complicated. Because filing Social Security at 62 as a couple is not the same financial event as filing as a single person. And the order you file in matters more than almost anyone realizes. Here's why. There's a spousal benefit equal to up to 50% of the higher earner's full retirement age amount. There's a survivor benefit that kicks in later. And how and when each person files affects both. The spousal benefit only unlocks once the higher earner has actually filed. So if the lower earning spouse files at 62 expecting some kind of spousal top-up, but the higher earning spouse hasn't filed yet, well, the top-up isn't there. Comes later. And if you've been divorced from a long marriage, this gets even more interesting. If your marriage lasted 10 years or more, you've been divorced at least 2 years, and you haven't remarried, you can claim on your ex-spouse record without ever talking to them. They don't even need to know. Their benefit isn't reduced by your claim. And a lot of people at 62 have no idea that's even on the table. I'll give you a real example. We had 2 couples come through last year, filed within months of each other. One couple coordinated. The higher earner waited, the lower earner filed at 62 on their own record, then switched to the spousal top-up later. The other couple, both filed the day they turned 62 because, they earned it. The lifetime difference between those 2 outcomes was significant enough that I won't quote a number. But it bought a small condo. So sit down with your spouse or pull your old marriage dates if you're divorced, and actually map filing order on paper. Now if you want to see how my team puts all of these calculations together for clients, side by side. Claiming age, earnings test, spousal coordination, all of it on one page, there's a free training link below. It's the same process we walk every pre-filing client through, and it's worth watching before you try to file at 62 yourself. Check it out whenever you're ready. Now back to it. The next one is the one most viewers underestimate. And once you hear it, you'll see why. Most people pick a year. They say, alright, I'm filing in 2026. And they don't think about the actual month. But what if I told you the wrong month could cost you real money for the next 25 years? Because Social Security at 62 has a couple of date rules baked in that almost nobody talks about. The first one is sometimes called the birthday rule. If you're born on the 1st or the 2nd of the month, SSA actually treats you as if you reached that age the prior month, which can shift your eligibility window forward by 30 days. Small? Yes. But small times 25 years is real money. The second rule is the one that looks like a gift but isn't. The retroactive lump sum. If you file a few months after you become eligible, SSA may offer you a lump sum covering the months you skipped. Up to 6 months. And it sounds great, right? It's a check. Free money. But here's what they don't tell you in the same breath. Accepting that lump sum locks your monthly benefit in, at the earlier, lower amount, permanently, so you trade a one-time deposit for a smaller check for the rest of your life. That's not a gift. That's a trade. And usually a bad one. The third piece is Medicare. Your initial enrollment window opens 3 months before the month you turn 65. And if you've already filed for Social Security, you get auto-enrolled in Part A and B. And your premium gets pulled directly from your Social Security check. So if you're heading towards 65, your filing month sets up the Medicare math too. So don't circle a year. Circle a month. Write down which month you'll file, why, and what that first deposit will look like the month after. Now this next one feels boring until it happens to somebody you know. And then it's the only thing they want to talk about for a year. Social Security fraud at 62 is rising. And the most common version is shockingly simple. A bad actor gets your Social Security number, which is honestly probably already floating around from some data breach you forgot about. Then they go to SSA.gov and they create a My Social Security account in your name. Before you do. Then once you eventually file, they redirect the direct deposit to an account they control. And by the time you notice the deposits aren't showing up, it's already 2 or 3 months in. And you're calling SSA trying to explain that no, that's not your bank account while a stranger is spending your retirement. So here's how you shut that door before it ever opens. 3 parts. First, create your My Social Security account today. Even if you're not filing for 2 years, just so nobody can create one in your name. Second, Turn on the SSA account lock through the e-services portal, so any changes require additional verification. And third, when you do eventually file, set up direct deposit into a checking account that's only in your name. Ideally one with tight transfer alerts. Don't run it into a joint account that everybody can see. The whole upgrade takes about 45 minutes. Costs you nothing. And it protects every single dollar of Social Security you'll ever receive. Now here's a question most retirees never ask until it's too late. What's actually standing between your spending and your checking account in the years before and just after you file? Whether you file at 62 or you wait, there's still a stretch of years where your portfolio is the only thing keeping the lights on. And those years, the ones running up to and just after filing, are some of the highest sequence of return risk years in your entire investing life. What does that actually mean in plain English? Picture this. The market drops 20% in your first year of withdrawals. You're selling shares to cover groceries. So now you've taken a paper loss, the kind that normally recovers, and you've turned it into a permanent one. Because once you sell those shares, they don't get to participate in the recovery. They're gone. And one bad year early on can shave years off your portfolio's life expectancy. So the upgrade here looks specific. 3 layers. First, you carve out a cash bucket. Roughly 24 months of essential spending in something stable, money market, short treasuries, high-yield savings, whatever lets you sleep at night. That's not investment money. That's permission to not sell money. Second, you build a bond ladder for years 3 through 5. Individual treasuries or CDs that mature on a schedule, so you've got known cash coming in regardless of what the market does. Third, your equity portion finally gets to behave like equity. It can drop, it can recover, and you don't have to touch it for at least 3 to 5 years. So when somebody asks me how to invest at 62 while filing Social Security, the answer isn't a fund pick. It's that bucket structure. Because in a downturn, it's not what you own that protects you. It's the order you spend it in. Alright, last one. And honestly, this is the one that bothers me most when I see it skipped. In most marriages, one spouse earned more than the other across their working life. That's just normal. But Social Security at 62 has a quiet rule that very few people understand. And it only shows its teeth on the worst day of someone's life. Here it is. When the higher earner eventually passes away, the surviving spouse keeps the larger of the two benefits. But only the larger one. The smaller benefit goes away. So if the higher earner files early at 62 and locks their own benefit at the reduced amount, they've also locked the floor for the surviving spouse at that reduced amount. Forever. And that decision doesn't look like a problem during the years both spouses are alive. The checks come. Life goes on. It only shows up the day one person is gone. When income gets cut in half, expenses don't, and the survivor has fewer levers left to pull. So before either of you files at 62, the upgrade is concrete. Write down on actual paper who files at what age, in what order, and why. Sign it together. The higher earner has the most flexibility here, and often delaying that filing, even by a few years, raises the survivor floor for the rest of the surviving spouse's life. That's not a tax move. That's a protection move. And it's the kind of move you only get to make once. So why do all 8 of these in this exact 12-month window? Why not after you file? Because here's the part almost nobody tells you. The moment you click submit, your benefit number is essentially set. Yes, technically SSA gives you a 12-month do-over. You can withdraw the application, repay every dollar you've received, and start fresh. But almost nobody knows that's an option. And almost nobody can write the check to repay 6 months of deposits. So in practice, your filing decision is one way. Every one of these 8 upgrades requires space for clear thinking. The earnings record audit, the longevity model, the earnings test plan, the spousal coordination, the filing month, the account security, the portfolio bridge, and the low earner spouse protection. Each one moves slowly. Each one needs a little bit of paper, and you do not want to be running them under deadline pressure. The quiet 12 months before filing is the only window where you can find that space. Because once the check starts, the structure is locked. And that window is short and it doesn't come back. So this isn't about delaying Social Security at 62 forever. It's about giving yourself enough room to file the right way on your terms with the right number locked in. If you want to see how my team builds this for clients in real life, the free training link below walks you through the full process we use. Take a look whenever you're ready. Thanks for watching. I'll see you in the next one.